We expect monetary policies of central banks to have a significant impact on global growth and financial markets. While asset prices may receive a further boost from abundant liquidity in our view, divergent policies are likely to increase volatility across asset classes. We remain moderately positive on risk assets, but believe in remaining cautious due to several geopolitical risks and stretched valuations in some markets. High-yielding bond sectors such as emerging market and corporate debt appear more favorable from an income perspective, given the historically low sovereign yields across developed markets. Some core European markets, Germany for example, are actually yielding negative rates on shorter-dated maturities. In comparison, US high-yield and European high-yield sectors offer a yield potential of above 6% and 4% respectively. For investors with a higher risk appetite, emerging market high yield can offer yields in excess of 7%. Valuations may look stretched in some of these markets, but we believe that the asset class may receive technical support from continued investor flows. While income from riskier bond sectors may appear attractive, we remain wary of a potential rise in risks, especially in the high-yield markets. Liquidity and credit risks do not appear to be fully priced in yet, which in our view reflects the continued abundance of liquidity. In fact, spreads have tightened across both markets since the beginning of the year, given the risk on investor sentiment in February. This has occurred despite a potential pickup in default risks, for example in the energy sector, which has been negatively impacted by falling oil prices. Moreover, potentially higher rates in the US may also trigger defaults among corporates with weak balance sheets. As a result, we are more positive on higher quality credit in Europe over the US and believe that hedging credit risks, at least partially, is important in this environment of heightened volatility. We are also positive on European equities for their dividend potential and believe that earnings growth should drive the market higher in 2015. The asset class should also be supported by a weaker currency and lower oil prices. Valuations in Europe are also more favorable, both in absolute terms and relative to US markets. Among other equity markets, Japan continues to remain an appealing market, supported by the accommodative stance of the Bank of Japan, low oil and commodity prices, and a weak yen. Dividend potential may also be strong for this market, as we expect cash-rich corporates to boost their dividend payouts in an effort to become more shareholder-friendly. We believe that liquid alternative asset classes, such as real estate investment trusts or REITs, should benefit in an environment of lower for longer yields and abundant liquidity from central banks, driven by loose monetary policies. A globally diversified exposure to REITs, ranging from European REITs, in France for example with dividend yields of 5%, to Canadian REITs with yields in excess of 8%, could be interesting from our perspective. In conclusion, seeking income from risky asset classes may be a necessity in an environment of low sovereign yields. A diversified multi-asset approach could help against a backdrop of lower growth and higher volatility in our view. It's time to proceed, but with caution. Thanks for taking the time to listen in. Please look out for our next quarterly update.